Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with the main man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to answer your questions, provide you with guidance. Will, I think you brought up your other screen to overlay.
Sorry about that.
No problem. So let's get started. I'm going to share my screen, and I've been getting a lot of questions actually coming through emails to talk about topics, on the pre-market show. So I'm going to try to cover some of these questions today. I'm not going to get to all of them because we did get, an unusual amount so far, and specifically requesting to cover them on this show. And by the way, I do have to thank a lot of people. I don't, read the compliments that we get on the emails, but I got a lot of really nice compliments with the emails. People thanking us for doing the show. People have told me, I'm the best teacher out there, which I'm not actually even a teacher or a coach. I just kind of share my experiences. But yeah, and I got people saying that they've been watching our show, which is unbelievable. For when do we start? Well, like 2 years ago, something like that.
We started when I had hair.
Yeah, the people have been watching, the show since then, and say that they can't even wait to see the next show. Really appreciate it, because on the other side, sometimes people criticize me too and say, "Hey, you sound boring," or you say a lot. And again, I'm not a personality. We're not like we're not YouTubers, and I'm not even a teacher. We just do.
Surprisingly, you are a YouTuber and a personality now. We didn't start out that way.
Somewhat.
And a lot of the chameleons think of you as a professor, so you do bring a lot of value to the community.
And we don't try, because that's.
But you're not. This isn't why you started Market Chameleon. You're just trying to help the users of Market Chameleon every day answer questions.
Exactly. We just took it to kind of answer questions, maybe figure out people's pain points and see if we could help and get people interacted. But definitely getting very nice emails. And sometimes, I get emails, people like to be entertained and they find either I'm boring or hard to listen to. And I'm sorry about that. But again, that's not our goal. We don't try to make ad revenue from YouTube. We don't, charge for this. We just try to answer questions and figure out people's pain points and guide them to where we think, they could look if they're looking for something in specific. So let's do this today because I've been getting some questions. I wanted to go over, I was talking about one of my daughter's friends, 16 years old, really sent me an impressive email. I think said that he uses Market Chameleon, which I was surprised. And after reading his email, I could really see he was into it, talking about implied volatility charts, volatility straddles. I mean, I don't want to read the email to you guys. I usually don't, but you could tell that took a lot of serious study and education and figuring things out. So I wanted to cover some of the questions he had in the email today regarding leveraged products, and he was looking at straddles. So what I'm going to do is actually kind of go over how I would model a potential opportunity in this leverage product. And I was trying to look at my old notes because I did create trading models for them. I couldn't find them, but I'm going to just kind of quickly give you the basis to get you guys started. We also had a question yesterday to go over an example of a pre-earnings straddle. And I think that's actually one of our alerts. If you look at the alerts that we produce over here, and when there's a pre-market straddle that looks attractive, it will alert you, but we'll try to cover those two. And I know I got more questions, so let's save those questions.
We also have
later.
A lot of questions lined up. Lauren has a question you wanted to come on Zoom. Do you want to try to do that today, or?
You know, I don't know if I'll have time for all of this. I'm gonna try. I'll go over things, you know, quickly. Some people ask me to slow things down. Some people ask me to go through things quickly. Lauren, if we don't get to today, can we do it tomorrow, or later in the week when you come back? Just because I've already promised to answer some of these questions earlier in the week.
All right, perfect. So Lauren, if you can come by on Monday,
or tomorrow,
Monday or next week, whenever you have a chance. Or sorry, Monday. It's only Wednesday, right? Tomorrow or Friday.
Tomorrow, Friday. Yeah, let's cover them. So let's quickly take a look at the pre-market report. I'm going to jump to these, try to get these two questions in today. Okay. So this is the pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Got 134 stocks on our percentage gainers list, 31 on the decliners. From this perspective, we're looking like a more bullish bias at the open. I'm going to filter this list down to S&P 500 stocks only, see what's going on there. We want to take out ETFs, leverage products, closed-end funds, all those. Let's remove them and see what's going on in S&P 500. I'm going to use this filter here, drop it down. I got a list of ETFs to choose from. Let's pick SPY. That's the S&P 500 ETF. When you select that, you can see the list below gets filtered by stocks that are holdings in SPY, which are the S&P 500 constituents. And here we got 24 stocks made our percentage gainers list, one on the decliners. So again, looks like it's setting up for a more bullish bias at the open. The top three that made the list, they're all earnings. So we could see here, Nike had earnings, FedEx had earnings. I think this is Carnival, also had earnings, all up after reporting. So if there are no questions, or actually, I'm not going to take questions.
Yeah, there are lots of questions, but yeah.
All right, let's save them for today, because I do want to get to these questions. And let's go to SPY. I'm going to use SPY as an example here. Let's go to the options chain. And this question, that I got, it was regarding doing straddles in a leveraged product. Okay, and the idea is there. Well, if I use a leveraged product to do a volatility bet on a big movement, it moves much more than the underlying. Let's say SPY, and I just found another leverage product. This is UPRO. I'm going to go down here. I'm going to bring up this options chain. And UPRO, if you read about it, hear about it, it basically works as a triple of the underlying. So whatever, SPY, let's just say we use SPY as the S&P 500. On the day, whatever SPY moves, this will move on a percentage basis, triple that. Okay, so if SPY moves 1%, this should move 3%. It is pegged to that. Okay, so, but it is pegged to daily returns. There's a reset that makes it important, but I just wanted to show you before we get into the options what's going on. Okay, so this is a leverage product that's 3x. Okay, the triple. Okay, and the question did deal with a straddle and the idea that, well, you're not going to get this implied volatility crush like you would in the stock because it doesn't have earnings. And your risk is the decay instead of implied volatility crush. And there were some assumptions in there that you'll learn over time. Implied volatility can still drop. Doesn't just have to decay. Implied volatility could go up or down. Okay, even if it doesn't act like in earnings where it just like drops significantly in one day as expected, implied volatilities do move around. So you can have decay plus an implied volatility moving down at the same time. But what I wanted to show you guys, and the question also, why was a good question, because it had some of the important elements of a trader, and he created a thesis, a hypothesis, and then based on the hypothesis, he also talked about average movements, volatility, and an expectation. And when you're doing an initial trade setup, initial model, or something you're looking for an opportunity, that's kind of a pattern you start to follow. First, you have a hypothesis, a thesis, and based on that, you have to come up with a model or a way of an expectation of something, and then you measure your expectation versus the outcome, and then by doing that and comparing it, you start tweaking your model, based on that experiment, right? What did I get wrong in my hypothesis? What do I change? How do I start to tweak and improve this model? Does that make sense so far to everybody? And I'm trying to go through quickly. And essentially, when you're doing trading, I know a lot of people like kind of get into it and think about it, forecasting stock going up or down. But that's not really trading. Traders look for positive expected values. Okay, sometimes they refer to it as EV, positive EV, but it's not electrical vehicle, it's an expected value. Basically, you're doing a trade that has some kind of an edge or an expectation that it will be profitable at the end. Okay, so how would we look at this UPRO if we are just starting out? Well, we know that based on this simple information, right, if we're building a model, that this moves three times the S&P 500. So then I start building the model, and let's go out to December 30th. And I'm looking at this and saying, first, I need to know that these options are not mispriced. So I need a way to price them. And if they're not mispriced, that's fine, but I need to know that because I don't want people to have more information than I do. And I'm not going to assume that they're always priced correctly. And how would I price them? So the simple way is saying, okay, if I take that at the money in SPY, right, and I compare, and I take that implied volatility, and I compare it to the implied volatility of UPRO, well, my expectation is it should be roughly triple, right? Because this is going to move three times with SPY, right? And if it's not, then I got to figure out why, right? But if it is, okay, so it kind of fits my first assumption. So I would look, so I set up SPY. Let's go to December 30th. Expiration. And look, I'm not getting an exact at the money, but let's just roughly look at it. And you could see here that the calls are 18.6, the puts are 17.8. This probably has to do with, our cost of carry assumption with interest rates, but let's just say roughly 18. Okay. I'm just doing a rough estimate without running our calculator, roughly 18, which means that if I look at the same expiration in UPRO, we should get roughly, what's that, 54? Well,
yeah,
three times 18. So then I look there And here's where the at the money's, not exactly. You could see here the midpoint's roughly 54. Right. So in a call and a put. So if I pegged it to that, that looks like in line, but I would have to continuously peg it to figure out, hey, it went out of line or not. Because I could always create an arbitrage by buying one and selling the other, because they're going to correlate. They should correlate throughout the day at a one, right? One correlation is just one's going to move 3 times as fast as the other, but they're going to either move up together, move down together, 3 to 1. But okay, the at the monies are easy. Then I have to figure out what about all these other options, because there's a skew. So not all these are 54, right? Not all of them are 54. So then I got to go back and say, all right, now my model needs to run a regression through all these strikes, right? So I got SPY, I could run a regression through all these strikes, figure out the implied volatilities, and then match them up with the equivalent strikes to UPRO, right? So then what I will do is see if any of these wings are out of line relative to where SPY is. And remember, that's because why? I don't need to take a directional risk anymore. I could just trade one option that's overpriced relative to another option, right? And if I could do that a lot, right, it adds up. And virtually the idea is that I'm reducing a lot of my risk. I'm getting rid of my gamma risk. I'm getting rid of my vega risk. I'm getting rid of the theta risk, directional risk, right? It's just a relationship that I got to manage. So that would be my next step: run a regression or best fit line, match up the equivalent strikes, and see if any of these are out of line. And if they are, then it could create an arbitrage, or not exactly an arbitrage. There's other things involved, but you guys get the point where I'm trading one option versus the other, where the underlying, right, where the underlying has a direct relationship. But then, what's my next step? Well, if you read it further in detail, what happens is that this is not based on log returns. It's based on simple averages. So to make it fast, because I'm going to try to do this fast, but I'm getting you guys started, right? I'm just getting you guys started how to think of things. And these leveraged products, and this is important, that's why I wanted to bring it up, have a negative drag to them. And it's the way they're set up. They're set up to peg 1 day's return, and then it resets. Okay, so it's not a month return, it's not a 2-week return, it's a daily return. That makes these products have a negative drag. So my assumption then, has to change. I have to account for it. So even if I ran that model, now I have to go back and say, how do I price in a negative drag? And I'd like to see if somebody can come up with that model. And if you figured it out and you'd like to share and come on the show, welcome. Maybe we'll give some kind of reward. But there's a negative drag.
A reward?
Yeah. I don't know. Well, I have to think of something because I didn't have it in mind. But as I'm going, I would like to give somebody some kind of a reward if they come up with the model and share it with somebody. But don't do it for the reward. Do it because you want to challenge yourself and figure out the mathematical problem. And if you can, you're really on your way to a much more, advanced thinking of a trader. But what is the negative drag? Really quickly, the idea is this. If let's say SPY, right? If SPY goes up 100% today, right? If it goes up 100%, it's unrealistic. If it goes up 100%, just to give you a demonstration, then UPRO is expected to go up 300%, right? So, because that's how they move. But then everything resets, right? And let's say the next day, it was like 100% was way overdone, right? That was like, whatever it was, we're going back down 50%. Okay. So if it goes, let's say it goes from, let's say SPY, to make it easy, went from 400, right, to 800. And then the following day, we're like, you know what, whatever we priced, we're wrong. The Fed's not cutting interest rates. They're going up back to 400. So the next day it's down 50%. Well, what happens to UPRO if SPY goes down 50%? Anybody guess? What's going to happen to UPRO? If SPY is down 50%, what is UPRO expected to be down? 150, right? 3 times that. Well, it can't go down 150%. It could only go down 100% to zero. Basically, it's out of business. Okay. It will be out of business.
You 100% sure it can't go negative? Like you owe money?
Well, if you're buying this, it's not going to go negative, but you're out of business, right? UPRO is done. It's out of business. It doesn't exist anymore. It's all gone, right? But SPY will not be gone, right? SPY will still exist. And that's why there's a negative drag based on the relationship that they're holding versus each other is not based on log returns, it's based on simple returns. So when the model I showed you would not work because you'd have to compensate for that. Okay. But that's how you're starting to build the models, because when you're doing that, then it'll be easier to find out where there's positive expected values. And what I showed you is if you could do that, not only would you be able to then spot much easier mispricing of options and take advantage of it, but you're going to be reducing your risks significantly when you do that. Okay. Now,
hey, D,
yeah,
we had more of a point or a thought from a new chameleon who just popped in today. He said the options liquidity for the underlying is so poor, I would be scared to trade anything in the UPRO. What's your thought on that?
Right. So what I was just showing you is that not to directly trade UPRO, right? You missed the point. But you're buying when you're doing an option that's illiquid and you're buying it, let's say, for a very good price, you could hedge that off in SPY. So what you're thinking is, well, why would I trade an option in UPRO? Because if you trade that option in UPRO and do nothing else to hedge it, absolutely nothing, or even the stock, then you're carrying all that risk of the UPRO option, right? Then you're carrying the gamma vega and also. But if you're taking that option and saying, well, here's a light product that I could hedge it off, a much tighter product. So what are you doing? You're taking a liquid product like SPY and taking an illiquid product that could potentially have an opportunity, and you're hedging them off. And that's how arbitrage, by the way, works. It's always where you're saying there's an illiquid product here that's getting mispriced.
Yeah, and you also can scan
liquid price. And what you're missing out is that fear that you have, right? That's where the biggest opportunities are live, right? That's because if you figure out how to price and hedge off an illiquid product that has a lot of opportunities, wider spreads and so forth, those are the biggest opportunities out there, right? Those are the works.
If it's illiquid, you may find something maybe so wide, you may find something sitting on the book, right?
Sitting on the book that's misread. Right. Now, remember, I'm not telling you to go doing this, right? And go buy and sell. the first thing is always you're building that model. Always the setup takes much longer than the execution, right? So the setup is always much longer. It's always more tedious. It always takes time and effort and testing, and then going back and saying this wasn't according to my expectation. What did I do wrong? Tweak it. The setup always takes longer. You know, if a person, anybody jump into execution first, you know, is just not doing it right anymore, you know. And I think there is this feeling that I have to go to execution, I gotta go trading, but the setup always takes longer, and it's time consuming. And just to give you an example, this model that I'm talking about here in what I'm describing, I think took me a couple months to build out, to test, to figure it out, and not only the model, like, you know, I had to estimate the volume, the expected return, what it would cost me then to actually set up and maintain that trading operation. You know, there's a lot more involved to it. But as far as, you know, trading any liquid product, just trading the way you're describing, yes, you know, that I wouldn't suggest, you know, go trade a liquid product. No, but what I was describing is if you're pricing, you know how to price it, and even though it's illiquid, and you know how to price it, and you know how to hedge off that risk, that's where your opportunity would be. All right. Actually, it's right up at 9:30, Will. I'm not gonna have time to get to the earnings straddle.
Yep. Well, he was nice enough to join today. Hopefully he can join tomorrow. Also, you can send us an email, support@MarketChameleon. And when the video is out, I could also email it to you if you can't make tomorrow's show, but hopefully we can get to his question tomorrow, Adi.
Yeah, we'll get to the question tomorrow. It's a good question. I think we actually have an alert to look for pre-earnings straddles. And the idea there is that what we're trying to set up is to see if we could get gamma or a straddle, own a straddle that's going to be at a discount or virtually free for a couple of days. If we could ride gamma for free or at a discount or at a low cost pre-earnings. All right. So that would be the opportunity to look for. And let's do that one tomorrow.
Yeah, and that's from the new Rob. So Robert, if you want to come on and click the link, I know I was late with the link this morning, but if you want to click the link tomorrow to the Zoom, you could actually ask your question live as well, or be on it. So if you have any other questions as it's going on, since it is your question. But great job, Dima.
Yep. All right. Thanks everyone for joining. Stay safe out there.